I'm University of Illinois Extension's Todd Gleason, your host for the morning for this Farm Profitability and Risk Going into 2022 webinar. It's a webinar by the FarmDoc team from the U of I. Today's topic, income taxes and management. We're joined by Bob Rhea. He's the Chief Operating Officer for the Illinois Farm Business Farm Management System, and Gary Schnitkey is here, agricultural economist from the University of Illinois. We'll take up a series of topics for the day. They include the current financial position, income taxes, and AMP, the Agribusiness Management Program. We'll get started today with a poll. What do you expect incomes to be in 2021 relative to 2020? You think they'll be much higher, slightly higher, the same, lower, or much lower? Go ahead and take a moment to fill out that poll, and I'll remind you that our sponsors for today's event and for the FarmDoc website include TIAA, the Center for Farmland Research, Compeer Financial, Corteva AgriScience, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers Association, and the Illinois Soybean Association. Our thanks go to them and for all that they do to make sure that we can stay on the air in this case and help to put the FarmDoc team and the FarmDoc Daily website in place. Let's finish that poll up and we'll show you the results. Here they are, much higher, say 24% of you. Slightly higher, say 43% of you. That's a pretty large number, I would think, by the time you add those two together, that are much to slightly higher for the expectations for the year. The same, just 14%, lower 17%, and much lower, only 2%. We'll pick up with the current financial position now. Gary Schnitkey is here. Gary, do the numbers reflect a slightly to much higher income for the coming year?
For 2021, we are expecting higher incomes, and we'll go over that now with the current financial position. Actually, when we're looking at FBFM data, we do not have 2021 income yet, or from FBFM farms, because they're busily preparing financial statements for farmers, and that data will come and be aggregated here together very soon. So we are saying that incomes in 2021 are projecting $325,000. That is up from slightly over $250,000 from last year. And Bob is in the midst of all of that. And what are you seeing out there as you look at financial statements and go through things, Bob?
Well, good morning, Gary. Thanks for that introduction to FBFM data. We are in the middle of that. I think we really started to get a feel for that as early as November, as people began down the path of tax planning and year-end strategizing for both thinking about 21 and 22. As we indicated, higher incomes are primarily coming from crop prices, and also relative to that are the end-of-year inventory prices that we're using. Those are much higher than we started 2021 with. So just on good to normal to better than average yields, coupled with a higher price and inventory price, we expect incomes to be rising in 21 versus our recent history of 15 through 20.
Yeah, and moving forward to 2022, we are projecting $130,000 of net income with a corn price of $5 and $12 soybean price. We would be currently higher than that, but in any case, we were projecting 2022 incomes to be below 2021 incomes, and the primary reason for that is much higher cost. Fertilizer leading the way, but all costs leading the way, as well as cash rents going up. If we see any deterioration in those prices, 480 and 1050, we could see lower incomes still. But we think at this point, by the end of this month, and if farmers purchase crop insurance, our very tail end will be cut off because those crop insurance guarantees will provide a backstop against very low incomes. So we're still looking at the possibility of lower incomes in 2022, but less so than we would have had had there not been the crop insurance program in place. to give you a little bit more deep feel for what we're looking at here, what we're looking at here as far as income, and this would be back to 2020 from FBFM records. Net farm income in that year was $240,279 across the state. Again, that was up, and we expect 2021 to be higher. If we look at that on a labor and management income basis, it would be $188,000. All of these data, as we're looking at incomes for 2020, 2021, and 2022, do include federal subsidies. So that would include all the MFP, CFAP payments, and ARC PLC payments that have happened. We also continue to look at family living cost. Those are broken down in FBFM records, and those breakdowns can include contributions, life insurance. When life insurance, both of those in 2020 were a little bit down from 2019 levels. Our family living capital was down also in 2020 compared to 2019. Medical was down and expendables were down. If we go back to 2020, we remember that year was the year in which COVID became apparent. Farmers and others battened down the hatches and spent less money on family living. Moving into 2021, we would probably expect some rebound in that because of higher incomes, as well as just the need to have more family living and that medical and other things going back up. Our net non-farm income has been rising over time. Our FBFM farms have $47,892 of net farm income, not net non-farm income in 2020. And we would expect that trend to continue into 2021. And Bob, that net farm income is very critical for farms and where those farms are going to be going from a financial perspective.
They are, and there's a couple of critical components to that. It's not only the cash wage measurement that's included as revenue and as taxable income, but it's also the growing value of those employee benefits that are provided for some off-farm employment, including health insurance. Some of the taxes are paid by the employer. It would include retirement plan contributions by the employer. So in addition to this 48,000 of income number, a pretty sizable value in fringe benefits as well.
And as we look at what income and Social Security tax payments were in 2020, $24,214. And again, tax planning was a big deal in 2021. Any projections there, what income and Social Security taxes are going to be doing in 2021, Bob?
Well, we'd expect those to perhaps rise a bit as we think about higher incomes, and it's also an indirect function of money that families spend on non-deductible expenses. And so if our living expenses from this chart jump from 81,000, let's say to 85,000, just that factor alone adds 4,000 of taxable income. That adds $1,200 or so of net Social Security and income tax. So that can push the number up. And I would just point out on this chart the difference that occurred in 2018 when that number dropped $7,000, a direct connection to tax legislation. The Tax Cuts and Jobs Act was effective in 2018, and one of the key features was providing a 20% business deduction that we'll see a little later on our slides, but has a real value to cut the tax liability of our farm families.
Yeah, and again, coming back here to net income, we're going to show some relationships here between net farm income and a number of other factors. Again, we were at $256,000 for grain farms enrolled in 2020. About a third of that did come from federal programs, CFAP and others. This year in 2021, federal CFAP and other programs are going to be very, very small, and most of our income in 2021 is going to be coming from grain sales. Overall, we see very little change in family living expenditures from year to year, and I guess that would be what you would expect. You can see income changes, but family living, it is hard to change from year to year. We again did see that come down in 2020. I would attribute that coming down in part due to what was going on with the COVID virus and the uncertainty that that did put in the market. One of the items that does vary with net farm income is capital purchases. In 2020, we had $164,000 of capital purchases. That was an all-time record. Capital purchases do tend to follow net farm income, and as farmers have higher net farm income, obviously they have cash flow to purchase capital items such as tractors, machinery, tile, etc. But they also have the tax incentive to use high Section 179 expensing to reduce taxable items. I don't know what we're seeing in 2021, Bob, but we saw a number of shortages in machinery, but higher incomes, and I don't know where capital purchases are going to come out in 2021.
This slide has another interesting dynamic, Gary, and then that's the tax incentivization that you described. I mentioned the tax rules changed substantially in 2018 to lower the tax rates to business owners, but you can see that lower tax incentive was still coupled with higher purchases. So it appears that income's a bigger driver than a tax incentive towards capital purchases.
Yes, it does appear that way. Another ratio that we look at is working capital, and in particular, the current ratio. Again, you're looking at current ratio here, and here is net farm income. And as net farm income goes up, we typically see the current ratio increase as well. Current ratio is current assets divided by current liabilities. You, in general, want that to be above 1 and above 2. Above 2 signals a great deal of safety, I suppose. And we are, again, seeing that go up. We were close to 2.5 at the end of 2020. Again, strengthening of the current position of farms. And I would expect that to continue in 2021, that we are looking at that current ratio and working capital position to improve on farms. Is that what you're seeing, Bob, or anything going on there?
Well, we were concerned, in 13 through 16 about some erosion in that working capital. And this slide and earlier one you showed, and we're going to look at the debt repayment capacity in a moment. But look at the point in 2012, best year ever in our Illinois record history, and 2015, worst year ever. And that is part of our theme today, is what uncertainty is coming forth for our farm families, because in that recent period, in only 3 years, we went from the top to the valley, and it'll be interesting to see how that plays out in 21, 2, and 3.
Moving on to our debt to asset position, we are seeing that as well come down. In 2020, we had a 20.21 debt to asset ratio, 21%. We would expect, or I would expect that debt to asset ratio to further come down in 2021. Again, we've had very good incomes in 2021, and so we're likely to see the debt to asset ratio come down. Having said that, we're seeing the debt to asset ratio come down. We are not actually seeing debt per acre on Illinois grain farms come down. We've seen a steady increase from $258 per acre back in 1991, and currently we have 712, or at the end of 2020, we have debt per acre of up to $712 per farm. So to get those lower debt to asset ratios, we're seeing the debt go up, but we're also seeing the assets go up as well. So we're seeing machinery, building, and other inventories increase, as well as land prices. These tend to be market value balance sheets. So as those go up, we tend to see price or assets go up as well. So as we're looking at that, I guess one of the concerns, Bob, is that that trend is increasing and has continued to increase throughout time.
Well, it means that with our higher incomes, we're not using it to purposely reduce debt. A lot of our farm families are expanding, adding equipment. Even if they're standing still with the equipment, anytime they're replacing it, it's going to be a higher dollar value. But even if they're, adding 80 acres periodically, that spreading that debt over their other owned acres increases this number. So I think it's more of a factor of expansion. But we know that debt is the biggest driver in debt to asset and in risk. And so we will be talking today a little bit about maybe it's a time to manage that debt. If we have $712 of debt per acre, and if a fair market value is $10,000, Gary, that's about 7% debt to asset ratio on an acre of land. That's probably still a relatively low risk number. And I'll have to pull out the Brad Zwilling's land value chart here to see how that would have compared in 1991. But I bet our debt to asset ratio is probably stronger, even though our total debt is higher. What would you think about that, Gary?
I would tend to agree with that. I think we are in a very strong financial position right now. Overall, farmers have been prudent with debt and still seeing that trend up. And at the same time, we're also seeing capital debt repayment capacity hit very high levels. At the end of 2020, we were looking at $289,000 per farm. Again, that signals that we do have the ability to repay the debt that exists out there. The last time we had is capital debt repayment as high as we were at was in 2012 when we had $304,000. So, and I just did that again. So we're looking at capital debt repayment capacity at very good levels. So coming down, we're going to look at our farm debt key points. Since 1990, farm debt has increased 4% per year. If we're looking at debt levels in 2020, it is the highest it has been in real terms. Again, our asset levels are going up as well. The debt to asset ratio has improved from 0.33 in 1999 to 21% in 2020. So we've seen that in general improve. And debt per acre has gone up to $712 per acre, and that was $258 in 1999. And interest expense per tillable acre was $24 in 2020 as compared to $20.72 in 1999. A lot of the reason why that 24 was as low as it was because of very low interest rates here in 2020 and in recent years. Bob, what are your takeaways from this before we begin looking at where we are at price-wise?
Well, generally debt is increasing, but we know assets are increasing. The third bullet point is the key. Financial risk measured by debt to asset ratio has declined significantly. So that's a much improved scenario. And just look at the impact, Gary, of interest rates. I mean, the debt per acre today is 2.5 times what it was in 91. And the interest expense is only about 20% higher than it was then. Such a good feature we've had in the last 20-year period of low interest rates that have enabled this debt to be accumulated without the same risk that we had in the 1970s and 80s.
Yeah, and we don't want to talk about the 70s and or 80s too long, but we do know that inflation is a concern, and we may be seeing rising interest rates. Overall, we're looking still at very good prices. USDA releases its market year estimates of 2021 prices. That was $5.45 for corn. Again, that's a very, very, very good level. $13 for soybeans. If we're looking at prices, we had long run equilibrium at sort of at 238 from 74 through 2005 for corn, 598 for soybeans, and we went up to 438 during the more recent period after ethanol build began, and 1063 for soybeans. even given those levels, we are at higher levels now, and that is for 2021 grain that is either being sold now or in the bin. But as we're looking at 2022, if we use projected prices that are likely for crop insurance, we're looking at $5.80 for corn. So that would be a good indicator of what we're looking at for 2022. And again, good prices for corn. Similarly, for soybeans, we're looking at something in the $13.80 range for soybeans. But I would also note that we have much higher cost. So turning, Bob, do you want to say anything?
Well, Gary, I'm going to add one thing to that slide. Just striking me as I looked at that slide. That's 5 years in the past decade or so above 550. Who would have thought that? That's a strong number.
That is a very strong number. And if you would have said we were going to be up there at 2021 or particularly at 2020, I wouldn't have never guessed that. And my guess is that most people wouldn't. So we're coming to our next poll before we turn into our income tax portion of the presentation. So if we launch the poll, we want to know, do you expect legislative federal tax changes to increase tax liabilities, have them remain the same, or decrease tax liabilities? And we'll let people vote. We've had a question of what is the ratio of debt to income doing? We would be looking at very low debt to income in 2020. Again, we had very high income levels in 2020, again, causing those debt to income levels to be very low in recent periods. How much of the expanding income was due to market facilitation program payments? And you got to go back to 2018 and 2019, and a significant portion of the income was due to those payments, roughly a third of it. But remember, back in 2018 and 2019, we had much lower incomes. So, Bob, here's what people are thinking about legislation, what's going to happen to tax liabilities. 74% think they're going to increase, 24% remain the same, and 2% think they're going to decrease. Does that match your expectations of what's going on here?
Well, it certainly matches the pressure that we see from the Congress and the lawmakers who are thinking about tax legislation pieces. A lot of those do have upward pressure on that expense. If we jump to the next slide, Gary, and look at our historical tax rates, I see a more positive feature here. I graduated high school in 1978, and at that time we had a marginal tax rate of 70%, which means that if I made $1,000 of extra income that year, 70% of that, $700, became my federal tax liability on that extra $1,000 amount. Today, our highest tax rate is 37%, almost half of what we had in my high school days. It's further reduced if we have business income, called this cubit deduction, which is the 20% deduction I mentioned earlier from the Tax Cuts and Jobs Act signed in December of 17. So effectively, if you have a trade or business activity, your highest federal rate is essentially just under 30%. The next piece is really key to me. It's only 19%, all the way up to about $350,000 of income. And so if you believe the poll question we just answered, that rates might be going higher, paying at a 19% rate might be a great idea for 21 and 22 taxes. Now, the overall tax has gone up because the income pool is substantially deeper than it was in 1984. When you have $120,000 worth of income, that generates a tax of $24,000. So still a larger outlay by our farm families, Gary, but it's at a lower rate. So as the economist on a call is, are you worried about the total cost you're paying? Or are you worried about the net effective rate of what you're paying, Gary? Which bothers you more?
Yeah, you would be worrying about that net rate and whether that's going to increase in the future, and whether or not, tax avoidance now we may be able to do some things that will reduce taxes now, but then we have the possibility of increasing taxes in the future. So that isn't the best scenario to be looking at, I suppose.
That's right. Well, our next slide describes what is an AGI goal. And the AGI goal for you is really a combination of these three factors. How much do you pull out of your business for living expenses, your income tax liability that's not deductible, and principal payments that exceed your depreciation deduction. Again, all three of those expenditures are non-deductible items that come out of cash flow. So you're going to have a grain sale of $130,000, spend this money from that grain sale, and you'll have a net income of $130,000 because these three things are not deductible. If your tax return reports AGI of less than $130,000, then to the point Gary just made, tax deferral is generated and you're increasing liabilities for later years to be taxed. Now, many of the proposals that were out this past summer targeted AGIs of about $400,000. Above that, higher tax rates. Below that, protected tax rates. So we'll see if that ends up meaning anything in 22 and 23. But that was some of the discussion in the past year. Now, many of the things that are in your books and records for 2021 are taxable, and many things in your books and records are not taxable. This slide that describes the ones that are not taxable is shown here. Many of you, if you're working on your tax return for a March 1 filer, or even if you're an April 15 filer, you've received 2 letters perhaps from the IRS describing your economic impact payments that were paid to you early in 21, I'm sorry. And if you have children under 18, you've received a letter about advanced child tax credit payments that you received from July through December. These are non-taxable amounts, but they impact the final result on your tax return. And if you had a PPP loan in 2020 or 21, and that was forgiven, that is not taxable. The interest that was paid through that loan and also forgiven, we think that interest on your PPP loan is a deductible item. So your full PPP forgiveness amount is non-taxable. Other items that you've received during the year are taxable. If your business had employee retention credits, meaning you met some gross receipt reduction thresholds, you have employees who are not related to you, and you receive these payroll tax credits, that's a taxable stimulus benefit to you. If you had yourself or your employees who are unable to work and you're getting paid sick and family leave credits, those are also taxable benefits. Well, I guess if you're self-employed, that portion is not taxable for your own piece. And then, of course, all types of FSA program payments, the MFP payments, the CFAP payments, livestock indemnity payments, any of those FSA program payments are fully taxable. Don't have any way to exclude those from income. One that's not here on the screen is crop insurance. Haven't had too much of that recently, but if you have crop insurance, it's taxable, but you might get to pick in which year it's taxable. Gary, let's talk a bit about the actual tax brackets and how they line up from lower income to higher. And we've listed the 7 tax brackets that exist today. They start at 10% once you reach $20,550 of income. And then after that, they go to 12%. The chart or the column on the far right, the cubit chart, this represents the net effective rate when we apply that 20% cubit deduction. So there's my slide that all the way up to $340,000, the net effective rate is only 19.2% if you are in a trade or business, which all of our farmers would be, all of our partnerships and S-Corp farming operations would be. C corporations aren't applicable here. They have their own set of tax rates, and they do not qualify for the cubit piece. But there's a large amount of income that can be taxed at this low 19% level, even up to $178,000 at only a 17% level. So that's part of the reason, Gary, we think about, well, rates are pretty low historically. Maybe now is a good time to push up to another bracket or two. And notice there's not a big jump even from the 22 to 24% bracket. There's no real change in the rate, marginal rate, until you go above 340,000. And that's when you jump from 24 to 32%. We start with the standard deduction, though. Everybody gets a certain amount tax-free. And depending on the type of filing status that you claim on your 22 tax return, these are the varying amounts that you get tax-free. And so you get this first, and then you go to the chart that we described for the different levels of tax rates. Farmers have different categories of income that arise. This slide summarizes into three groups and identifies the different rates that apply to these different asset groups. So if you're selling inventory, raised livestock, purchased feeder cattle, purchased pigs, corn and soybeans, wheat, any crops that you're growing, specialty crops, all of those are in inventory. You'll pay your ordinary tax rate that we described on the slide before, no more than 37%, but often 12 or 22%. But also, if you are subject to the self-employment tax, meaning you're a sole proprietor or in a general partnership, that self-employment tax is another 15% on top of that, let's just say 22% ordinary rate. When you have other types of assets, for example, equipment and buildings, you have the same ordinary tax rate, but no self-employment tax is applied when you're selling these types of assets groups. And the final one we described is farmland, and land is a different type of tax rate. Capital gain tax rates apply when you sell land for more than you paid for it, and those rates are 0% up to about 100,000 of total income, 15% up to about 400,000 of income, and above that at a 20% rate. So these are all lower than the ordinary tax rates, and there's no self-employment tax here either. And Gary, let's not forget about Illinois income. Our state of Illinois assesses tax to individuals at 4.95%, to C corporations at 9.5%. So if we combine all these together, you might have a marginal rate of, let's say, 22% ordinary tax, 15% self-employment, that's 37, 5% for state, that's 42. That is a very common marginal tax rate for our farm families today. That's still less than the 70% number, Gary.
Yes, it is. And again, a number of proposals that were made last year that didn't come to be would have raised some of those rates. And so we'll see where all those tax legislation go, if anywhere, coming up this coming year.
Yeah, great point. They would have raised the rates, but also might have changed the character as well on some of these activities. And in addition, we think at that point, the income level of 400,000 was still protected from some higher rate increases. Well, Gary, for many farmers that are self-employed or in entities that are subject to the self-employment tax, that's a pretty sizable tax. That can be as much as, the low $20,000 number on the tax return. And people say, well, what can we do to reduce that? Well, there are gifts of grain that you can make to charities or to family members that will avoid that self-employment tax. You can pay wages in kind through grain payments. Some very specific steps need to be made to do that, but that can eliminate the Social Security tax portion of self-employment. This next slide is interesting, and this came out just with the 2018 rules. When you trade in a piece of equipment, we have to report that as a sale. The good news is there's no self-employment tax on that revenue. Now, when you have a purchase, we record the full purchase price of that equipment on first your depreciation schedule and ultimately on your Schedule F. That does reduce self-employment tax. So we've always had this as a strategy for a long time, but now it's the law. This is the way we report equipment trades and it's favorable to lower self-employment tax. The self-employment tax, or at least most of it, quits when income reaches $147,000 level, because you only pay 12.4% of this 15% tax up to this income level. Above that income level, you only pay the remaining 2.9% tax. You can convert to a crop share or cash rent landlord, and those individuals who are now the landlord, they are not the operating farmer. Those individuals do not pay self-employment tax, but again, they're not involved in the farm operation. They're not making daily management decisions. They're probably going to lose some tax deductions along the way. But as we think about farms transitioning, it's important to note that when you do convert to a retired landlord, that self-employment tax does disappear on that income. As we think about transitions, Gary, one of the key challenges is how do we deal with all this inventory and these high income rates that might apply when we're selling off inventory? And Gary, we would think what an Illinois farmer might have 1,500 acres as a rough range, something like that.
That's correct.
And on a strong gross income year, they could have as much as $1,000 of gross revenue per acre. Does that sound reasonable?
That all sounds reasonable, and particularly for the year coming up.
That leads us to $1.5 million of inventory that has to be managed. If in 23 or 24 was the retirement year, you got to deal with all this inventory that's been built up over time. And our next slide, Gary, describes income averaging. It can help. For 21, you get to look back to 3 years, and mathematically it moves income from a high 21 tax bracket back to unused brackets in those old 3 prior years. What's the bottom line? It moves 37% tax rates if you have a high income back to any available 12 or 22% buckets that might be available from those 3 older years. For 22, we'll be looking back to 21, 20, and 19. So if you were able to successfully mathematically move $100,000 from 37% to 22, a tax savings of $15,000 from this look back income averaging. Gary, farmers are the only people in the whole United States who have this nice income averaging benefit available to them.
And I suppose they should take advantage of it, particularly at those times when we're thinking about retirement. And if we're thinking about retirement, how many years beforehand would you like to know that individual is thinking about retirement to do a good job from an exit tax management strategy?
Well, I think 5 years would be plenty of time, and people don't really know that far in advance. 1 year is absolutely too short. So 3 years, if you have 3 years, especially 3 tax years, you can put that together, and that might only be a little more than 1.5 calendar years. But the tax years are important as you think about liquidating inventory, and depending what you're doing with machinery, that's another huge asset group that takes some planning. But this income averaging can be helpful, but it's not a $100,000 tax saver. You see from my example here, it was a $15,000 tax saver. It's still helpful. One that's growing in interest is retirement planning and using retirement plans to continue to defer income to help in my example of a $1.5 million inventory. I listed 5 different plans here, traditional simple IRAs, 401ks. You can have a solo 401k, so even if you're a sole proprietor farmer, you can have your own 401k, no different than the large corporations provide to their employees. But look at the last 2 here. The self-employed pension plan and other defined contribution plans, you can defer 25% of your net Schedule F income up to $61,000. And this very last one, defined benefit plans, commonly known as cash balance plans, you can defer up to $245,000 in those plans, which means you're not going to have the money in your checking account anymore. You're going to sell a large grain inventory, put money into a retirement plan, and now it's in your retirement plan account, taxed when you withdraw it out of that retirement plan. It doesn't avoid tax. It just defers that tax and allows that tax from selling inventory to be spread out over more years. Now, this comes with risks as well. For the last few years, retirement plans invested in stock funds have performed very well, easily 10 to 20% rates of return. But I haven't looked at my 401k lately. It's not as much fun anymore, Gary. But we're down probably 15% of losses in those 401k plans since the start of the year. Well, that might be a little strong, but you need to be prepared for that different type of risk if you choose to defer income through one of these plans.
That's exactly right. And you're moving from one market to the other. So you're moving from the farming market to probably either a stock market for an asset or debt instruments, and both of those do carry risk.
One of the challenges on liquidating your farm assets is the selling of machinery. There's a unique, difficult, challenging tax trap here. We'd often think, well, I'm just going to take my $800,000 machinery line, sell it to my successor over time, $80,000 of payments a year for 10 years plus some interest. Doesn't work like that, sadly. If you sell this machine in an installment sale, you pay tax on the full contract price in the year of sale. Doesn't matter when you get paid, because of this depreciation recapture rule that we describe in the next bullet point. That's what causes this problem. And if you have a related party, they don't get any accelerated deductions, and the seller has large income in the year of sale. Just a bad answer all the way around. So selling machinery on an installment sale sounds like a great economic idea, which it is. It's a terrible tax result for both buyer and seller. So be cautious as you think about ways to move that forward. The next slide, Gary, describes maybe a better option, and that would be giving your machinery in a transfer through a long-term lease that has a periodic purchase option. And this next slide, Gary, summarizes that, and that gives you a chance to avoid this tax trap, but still have a commitment to someone to take over your machinery, maintain it, and use it, and lets them buy equipment from the seller, whatever terms you might align. So now that I'm sold my machinery, dealing with the tax sale, tax income from the sale, what about the buyer? Well, the buyer is looking for depreciation deductions, and they are as beneficial as they have ever been, but they're ending the most beneficial pieces in 2022. So for 2022, we still get 100% bonus deduction, but that's the last year. In 23, it's only an 80% bonus deduction. Even farm machine sheds qualify for this very rapid deduction in 21 and 22, but that's the last year. A different way to deduct depreciation items is through the 179 deduction. And there's a large limit here. $1,050,000 is the maximum deduction. And as long as you haven't spent more than $2.6 million, you can use that full $1,050,000 deduction. And for both of these, whether you're buying new assets or used, they qualify for these very fast tax deductions. Now, here's a problem with the next bullet point, that related parties don't qualify. And when we talk about related parties, generally think about lineal related party relationships. So my ancestors and my descendants, those are related parties that don't qualify for these rapid depreciation deductions for the buyer. Brothers and siblings, though, are not related parties for this fast deduction. So I can buy $100,000 of equipment from my brother and fully deduct that in 1 year. I added the definition for what is required because we know, Gary, we've heard about supply issues. I mean, I can't deduct this through depreciation until the asset is in a state of readiness for its intended use. So a machine shed that has all the trusses and concrete floor poured on December 31, but no walls, no lights, no doors, I don't think that's a machine shed eligible for depreciation in 2021 or 2022. Gary, one of your industry experts mentioned about availability of farm assets through 2022. We can order and buy things on time, or we're going to have some challenges maybe.
Yeah, that we are going to have some challenges on anything related to the supply chain, and equipment is one of those items that we are going to have issues with. We have a question here. Could you sell individual pieces in subsequent years to spread out income? And I'm assuming we're talking about equipment there.
Yeah, that's what we were describing in the periodic purchase option. So absolutely, as long as you actually have a bona fide sale of that piece of equipment in that year and it's not connected as a installment sale arrangement, then yes, you can spread equipment sales out over multiple years and recognize income in the year of sale. Great question.
So what about drainage tile for cash rent landowners? Is there special provisions there that need to be considered?
The drainage tile is one that qualifies for the 100% bonus depreciation. So that can be fully deducted in the year of purchase in 21 or 22. And that's one that moves to an 80% deduction in 23. A cash rent landlord is one of the groups unable to use the 179 deduction, but they can still get that tile deduction through bonus depreciation.
So to use that bonus depreciation and just can you just expand a little bit on a long-term lease with a period purchase option? Perhaps what does that look like, and what would that look like here?
Well, let's say I have a $500,000 equipment line. I'm going to lease that to my successor at a 12% annual lease rate. And that might be a little high compared to historic rates, but it's probably, at least 4%, maybe 6 or 8, but let's say it's 12%. So I collect a $60,000 annual lease payment, and I provide in my agreement the lessee has a periodic purchase option of not more than $100,000 in any 1 year. So in each year, they have the choice that they can buy $100,000 of equipment from me under that lease, and I know I'll have that income to be recognized as well. I've also seen where they're required to buy a certain amount, during that lease time. And then we would say, well, that $100,000 is going to go to the combine and a grain wagon, something like that. You identify the pieces that are being sold. They move off of my lease, and so now my lease is a $400,000 lease, and the next year's lease payment is only $48,000 because the successor, the lessee, has already made some purchases and reduced the value of the lease. Illinois has some changes coming along. They don't let us use the bonus deduction, and so if you use that in 21 and 22, your federal tax will be reduced by bonus depreciation, but not your Illinois tax. We don't lose the deduction. That deduction is just deferred. And so when you later sell that equipment or trade it in, you'll have a smaller Illinois tax liability at that point. Gary put up 3 quick slides about estate taxes, just to give you some time to close up here. Our 22 exemption remains at $12 million a couple. We can use 2032A as farmers to give us an extra $1 million. That puts us to $13.236 million of exemption. You can make gifts of $16,000 in 1 year to any other person. Doesn't have to be your related party. Gary, you can even give a gift to your favorite U of I farm economist specialist.
There we go. That's always a good gift to do.
Federal estate taxes are not a big deal for most of our farm operations. Look at that small amount, 0.16% had that obligation in 2020 because we have such a large exemption. The next slide describes some key features in Illinois that we do have only a $4 million exemption. And here's what an Illinois estate tax looks like. If you have an $8 million estate, that tax is $680,000, not quite 10% of the estate. So that's a pretty big number that we'd like to figure out how to avoid. One way to avoid that is make large gifts. If you gave away $6 million, you'd pretty well wipe out that Illinois estate tax, but you'd only have $2 million. The other $6 million belongs to someone else. You've also given up the income on that $6 million. Gary, the next slide describes a really key thing in farming. This is the stepped up basis. It was a big target in May of 2021 to be eliminated, but it did not happen. We still have stepped up basis. It's a huge, huge, huge benefit for all farm families, not just those who have an estate tax liability. It lets us reset the basis and increase our deductions. The bottom line is, Debbie and I have been married for about 41 years, and when I would die with my farm assets, she gets all those at a stepped up basis, and I would have a large deferred tax to pay if I liquidated my assets, but Debbie gets to sell them tax free, as if she needs another good reason to help me kick the bucket, right, Gary? So
there you go. We want to keep you around a long time, Bob.
Yeah, well, stepped up basis is good. Let's close this topic with a couple of strategy points to tie these things together. You know, this is a low tax rate time. Maybe we should use those to our advantage. This is a growing debt time. We know when we pay down debt, we're going to pay more tax. And we know we probably have an uncertain income time coming. So if we think about those three key points, that's something for us to ponder as we wrap up our 2021 tax return and think about our 2022 tax return. What makes sense for your farm operation? Any of these three things could make sense to hit. If they all three make sense, fire away and to work with your tax professional to make it happen. Here, our FBFM people are all over our state of Illinois. Be glad to help you with any of this. And Gary, one other way to learn about things is the AMP program. I'll let you describe that a bit for us.
Yeah, so we're going to take a look here at the AMP program, which is Agribusiness Management Program. This is an Illinois Soybean Association, ISA program, and it is an innovative program where we talk about a lot of these issues related to the business associated with farming and cover such diverse topics as tax management, estate planning, transferring the farm business from one generation to the next, and moving grain marketing and all those things that are associated with making the business of farming run. Again, this is a program by Illinois Soybean Association. There are a couple partners that are involved with that. One of those is Illinois FBFM, Farm Business Farm Management. Bob, you're the CEO of it and a supporter of this program. So, yeah.
We love this arrangement. We have a few staff people, Jesse and Emily, who've been doing some podcasts and presentations, and they're designing some curriculum and providing lots of really good, innovative ways to hear more about farm business strategies. It's been very successful in its original 2 years. Looking forward to upcoming events in 2022 to really hit home runs with this program.
Yeah, and we have FBFM associated with that and FarmDoc as well. So we are here at the University of Illinois, very proud to be a part of the Illinois Soybean Association. If you go to the Illinois Soybean site, you can see existing resources that are there. We have a number of videos that are looking at such diverse topics as the global impact of farming and risk through the eyes of a lender. So you can look at those items, and those again are available on the Agribusiness Management Program site of Illinois Soybean Association. There are some other new things that are coming up here as we move through this year. One of those are online modules, and we have 3 of them planned right now: Farm Financial Records, Pathway to Success, Benchmarking and Financial Ratios, and then Estate and Transition Planning. Deep and definitely complicated process to go through, but very key to the success of businesses, particularly as they transfer from one generation to the next. We also have podcasts there. Todd Gleason is leading those efforts, and those will, again, address various issues related to agribusiness management. And we will also be having an August 2nd AMP conference at the iHotel here in Champaign, Illinois. So look for those more information as we come up. Again, we will be doing benchmark and financial ratios and other modules. Those will be available online, and you will also be able to download books, iBooks, and PDFs that deal with this. And for example, our benchmarking and financial ratio module will deal with such exciting topics, but important topics as the debt-to-asset ratio, working capital, and debt replacement, something that Bob and FBFM work with every day and know the critical importance of those items.
We saw those earlier in our slides, of our historic numbers, and they continue to be really key measures on financial performance for your farm operation. No operations are the same, and we know there's a big difference between being a top third producer in these numbers and a low third producer in these numbers. We'll be able to help you identify where those marks are at and what can be done to move you to a top third level.
Yeah, and it's very critical financial management. It's always critical. One of the things to think about, though, is as we've seen here, we've had some very good income years, and it's often easier to make decisions when we are looking at good incomes rather than less so. So we have funds and availability to make those decisions now as we look at them. So Illinois Soybean Association has done timing of this AMP project is perfect. And again, look forward to seeing those modules and continue to grow that AMP resources. With that, we will come to the end of our scheduled comments. And Todd, do you want to take it away here?
You bet. Thank you so much to Gary Schnitkey and Bob Ray, both for presenting today. Gary, I'm really looking forward actually to doing the AMP podcast and putting that together. You and I have done one. I think it will be the third in the series of 10, and I suspect there will be more than those. More information about AMP from the Illinois Soybean Association, along with work from FBFM and FarmDoc. Of course, you can watch our websites and the Illinois Soybean Association websites for AMP. We would like to thank our educational partners for today's webinar. They include University of Illinois Extension and the Department of Agricultural and Consumer Economics here on campus, and of course, Illinois FBFM, along with our financial sponsors for the FarmDoc team. They include the TIA Center for Farmland Research. That's part of the FarmDoc folks here on campus. You can find them at farmland.illinois.edu. Compeer Financial, Corteva AgriScience, Farm Credit Illinois, Illinois Corn Growers Association, FS Growmark, and the Illinois Soybean Association. Jim Baltz has been behind the scene, and he will be tallying up those surveys as you exit. Thank you for filling them out, and encourage you to visit our YouTube website where you can find our 5-minute farm docs. Jim produces those. He's the executive producer. Well, I suppose the executive producers pay for everything. He's the guy, the workhorse behind them, and helps to put them together. And you can find them on our YouTube website at youtube.com/FarmDoc video. Of course, you can always go to farmdoc.daily.illinois.edu. Anything else to add before I let the folks go this afternoon, Gary?
Yeah, we have a couple questions, and I'll also remind individuals that we have our last webinar here this Thursday at 11 p.m. or 11 a.m., and that will deal with the commodity title choice and ARC PLC. We do have a couple of questions here, and one of that is a follow-up to our original discussion on interest rates. And here's the question comment. For years, ag economists have been saying that low interest rates were the only way that farmers have been able to stay afloat. As interest rates are finally rising, will bankruptcies rise too, or have high crop prices help offset the bankruptcies list and will allow farmers to continue to service their debt loads? That's a very good question, and obviously interest rates have been low, and we're obviously talking about going into 2022. So interest rates are rising, and we will see how far those interest rates go up. And I guess we're expecting interest rates to rise, but they will still probably be at relatively low levels. I would point out that we have a very low debt to asset ratio, very good working capital. So we will likely come out of 2022 and even into 2023 in a very good financial position. And we are not imminent here for a financial crisis, even if we do see rising interest rates. But it is something that we always want to keep in mind, because farming is a cyclical business, and so we have those concerns as we likely will see grain prices come down in the future. We have one question for Bob. How about charitable trust for machinery sales?
Charitable remainder annuity trusts, they're commonly called those CRATs, or sometimes shortened to CRTs, can be used to liquidate as a part of a liquidation plan for a retiring farmer for either machinery or inventory. Often they're plugged in with the inventory piece because that can avoid the application of the self-employment tax on those as well. But they also fit for any asset, and they fit for stocks and bonds. They fit for farmland. They fit for machinery. That contribution to a charitable remainder annuity trust can be a good opportunity to give some return back to the machinery owner, almost like you're leasing it to the charity for a long-term, relatively low-income lease. So those are often talked about. We very seldom see them in play, because what's really happening is you are donating that property to the charity. So that money leaves your farm balance sheet. That money leaves your family legacy. But for if that fits what your farm desire is, charitable remainder annuity trust can be very helpful in liquidating either inventory or machinery. And they do leave some income stream for the donor.
All right. Thank you, Bob, and thank you for taking time from your busy schedule. This happens to be the busiest time for FBFM, and we appreciate all our listeners. And Todd, why don't you take us out of this webinar?
You bet. We have one more webinar to come up in this particular series. Again, that's on Thursday, as Gary Schnitkey reminded you already. If you're here, you're already signed up. You'll get an email about that before it starts. We'll see you on Thursday morning. And then our next in the series of FarmDoc events will be the Will Ag Spring Outlook, which is Tuesday, the 8th day of March at the Beef House in Covington, Indiana. Our doors will open at 7:30 Central Time, 8:30 if you're in the Eastern Time Zone. The Beef House is just 4 miles on the other side of Danville, Illinois, on exit 4 off of Interstate 74, so it's easy to get to. Eric Snodgrass from Nutrient Ag Solutions will kick our day off, and then we'll continue throughout the day with the FarmDoc team and the panelists from Will Ag. And you can sign up today. The cost for that one is just $25, but it also includes the morning coffee and roll from the Beef House and a Beef House lunch. Get yourself scheduled for that one at willag.org, WILLAG.org. And Gary, we're looking forward to having you there. Thanks to everyone who's been here, and especially to Jim Boltz and Bob Ray, who have been along with us for today. Jim, of course, behind the scenes. You have a good day. I'm University of Illinois Extension's Todd Gleason.